welcome to the February edition of the CAFFE seminar series. So we are delighted to welcome two excellent speakers today on the topic of sustainable investing. So Theresa Spickers from the University of Amsterdam will present passive ownership and the environment. And then Joel Shapiro from Oxford will give a paper on sustainable investing and public good provisions. So thank you, Theresa and Joel, for accepting our invitation. Each presentation will take 25 minutes and will be followed by 10 minutes of Q&A. And there will be a final discussion at the end. So we encourage you to turn on your camera so that it feels like a more, real seminar. And I'll stop here. Theresa, the screen is all yours.
Thank you. Let me share my screen. Okay, does it work for everyone? Does it look good?
Perfect.
Perfect, thank you. So first of all, thank you, Laurent and Raman and Kim for organizing the seminar series and for inviting me. The paper that I'm going to present today is joint work with Vida and Goyal from HKUST, Daniel Schmidt from Munich, and Daniel Urban from Erasmus Rotterdam, who should also be in the audience somewhere. In a nutshell, this paper is about analyzing and understanding if passive ownership has an effect on corporate environmental performance and policies. And we think this is an important and interesting question to answer because in a recent survey, academics, policymakers, and practitioners rated institutional investors here as the second most important mechanism in making firms greener, actually coming in right behind carbon taxes. And what these survey respondents presumably had in mind is that what am I doing here? Sorry. That the institutional investors either exclude polluting companies from their portfolios, so classic divestment strategy, or that they engage with companies. However, the problem is, or it's not necessarily a problem, but there is a massive change in the institutional investment industry in the last 2 decades, roughly speaking, from an industry that was dominated by primarily active investing strategies, and now it's moving more and more towards passively managed strategies. So what you can see here, for example, as of 2021, the passive fraction in total, in aggregate total net assets for active and passive funds was roughly 40%. So in the light of this trend, what does this actually mean for the effectiveness of institutional investors in greening firms? Well, what we know about passive investors is they have relatively few incentives to engage with firms because, well, normally they have very, very low fees, meaning that primarily they compete on costs. Also, they do not exclude polluting companies because they are index trackers. So as long as the company is in the index, they won't divest. However, the fact that they are index trackers also means that their demand for shares is inelastic, meaning that they have a lower sensitivity to the financial performance of firms in their portfolio, which basically means that they don't penalize financial underperformance as much as other investors would. And this implicitly leads to these investors giving a subsidy for firms included in an index, which firms might then use to kind of invest more in more expensive but cleaner environmental projects. So kind of in the light of these two somewhat opposing arguments, we asked, do passive investors matter for firms' climate policies and their performance? And if yes, how and why? And what we do in our paper, or what we need to answer this question, is an exogenous change or shock in passive ownership. And what we do in this paper is that we identify new equity index launches, and we identify basically the firms that are incorporated in this index once it's launched. The nice thing about this identification is that from a company perspective, this index launch is largely unforeseen. So in our sample, on average, there's a 12-day time gap between the announcement of a new index and the actual creation of the new index. So as I said, from a company perspective, this is a relatively surprising event. We then assemble a worldwide sample of 62 new index launches, which span in total 30 different markets, and we cover time period from 2010 to 2019. And in total, we identify roughly 1,900 firms that are added to newly created equity indices. So here in panel A on the right-hand side, you see kind of an overview of the different markets that we have in our sample. And as you can see, it's really all over the place. So we have Japan, UK, also the Netherlands, but also South Africa, for example, Canada, Italy. So really worldwide sample. And something important to have in mind is that we have both conventional, so non-ESG indices in our sample, but also ESG indices. And we don't primarily kind of filter only on ESG indices or anything like that. And I can already tell you now that kind of this identification works nicely in increasing passive ownership. So we find an increase of 0.25%, which is roughly 6% of standard deviation in passive ownership. So the number feels low, but have in mind that this is really kind of the lower and most conservative estimate of passive ownership and or index investors that we can identify. So we know that kind of even many investors that we would classify as active are actually relatively close to tracking an index. And kind of we'd find no change in total institutional ownership. The type of analysis I'm going to show you in a minute is primarily based on a difference design. So we have a treatment group, which consists of the firms that are added to a newly created index. And we have, Joël, you have a question or?
Yeah, I just wanted to ask
Yeah.
clarification, which is if there's a new index, does that mean necessarily that there's new funds based on that index? Because I know the index providers are not the same as funds.
Exactly. So that's basically what we have in mind, that then kind of ETFs and other funds kind of track and benchmark against this index. And this is what would bring about kind of the increase in passive ownership in these companies. So where was I? Okay, we have a treatment group and we match a control group by using a nearest neighbor matching. We match on size and the environmental score prior to treatment within the same country, industry, and year. So the control firms in our sample have never been treated by an index event in our sample, which doesn't mean that they are not also part of an index, just not within our sample. And the final sample consists then of 1,900 treatment and control firms, out of which we have roughly 1,200 unique treatment firms and roughly 400 unique control firms. And the difference regression is going to be a stacked regression. So in all of these regressions, we include event time firm fixed effect and event time year fixed effect to address these kind of more recent concerns around treatment effect heterogeneity. Okay, so this is our main result. And what we have here on the left-hand side is the Sustainalytics environmental score. And what we see is for treated firms in the post period that we have an increase of roughly 1.5 points in this environmental score provided by Sustainalytics. So this score ranges between 1 and 100. So we have roughly an increase of 1.5%. In the last two columns, we split kind of our index events into conventional and ESG indices, and we see that the effect is primarily coming from the conventional indices, so not from the indices that scored based on ESG criteria, which is roughly in line with the recent working paper by Sam Hartzmark and Kelly Shu, who kind of suggests that it's very difficult to make a green company more green, but it's kind of easier, relatively speaking, to green a relatively brown company. Because it's a difference design, I owe you parallel trends, or to test and to show you parallel trends, and this is what we see here. So parallel trends assumption holds, and then we have a relatively steady increase in the following 3 years in the environmental scores. Now, I guess most of you know that kind of these scores are, well, not perfect, let's put it like this. So we use alternative measures of environmental performance. The first thing that we do is we look at carbon emission intensity. Here we use data from true cost, and we only include actual reported emissions, not the vendor estimated emissions. And we look at scope 1 and scope 2 emissions, which is the direct emissions from the company, and indirect emissions that they kind of buy or that they kind of emit by buying energy, for example. We do not look at scope 3 emissions because honestly, the data is just not there. Especially for an international sample, the coverage is really, really low if you exclude vendor estimated emissions, and if you have kind of a relatively global sample. Okay, so what do we find? We find strong decrease in emission intensity in scope 1, so in direct emissions. We find a small increase in scope 2 emissions. And on aggregate, we still kind of find a total decrease in scope 1 and scope 2. Now, why do we find an increase in scope 2 emissions? We discussed this with some practitioners who kind of work in the space of greening companies, basically. And they say this is actually a good thing, because they want to, for many kind of companies, it's better to outsource emissions, where emissions can then be better abated than what the company could do on its own. So, for example, if you use a specific chemical component in your production process, and you could either produce it yourself and have a lot of emissions, or produce a lot of emissions, or you can buy the compound from a specialized manufacturer who has then way better abatement technologies. So this is here a little bit the argument why kind of the practitioners actually like this result. We also look at MSCI IVA environmental scores. So as an alternative score provider, we find a remarkably similar effect. So the MSCI IVA score ranges from 1 to 10. Remember, Sustainalytics is from 1 to 100. So in terms of magnitude, these 1.8 come very close to the 1.5 that we found earlier with the Sustainalytics database. So all in all, this seems to be a relatively robust result, and we also run an additional robustness checks. And the most important that I want to highlight is that we also implement an RDD regression design in case you are kind of a little bit worried about the identification assumptions that we have with the difference in difference design. We also compare in this RDD companies that have just not been included in the index with companies that have just been included in the index, and we find very consistent results. The reason why we don't use this for our main specification is because we have this information only for roughly half of the event, or even less, that we have in our sample, and then we just have every once in a while a power issue. So that's why we basically go forward in an additional analysis with the DID regressions. We also implement alternative matching procedures. It doesn't make a huge difference. We control for prior index membership. We run a bounding analysis for a DID term to address potential omitted variable bias. We control for other firm level dynamics, which might drive the environmental performance. We control for potential spillover effects, and none of this has any sizable effect on our main result. Okay, so now that I've kind of established the main result, we see an improvement in environmental performance. We kind of analyze different potential mechanisms that could drive this. So I already alluded kind of to the first mechanism that we have in mind, which is an index inclusion subsidy, where investors who more or less track an index, so who have a relatively low active share in their portfolio, are less sensitive to changes in profitability, because what they primarily care about is tracking the index. As long as firms are in the index, they won't do much, which means that more expensive yet cleaner environmental projects are penalized less when investors have an inelastic demand for firms' shares. That means from an indexed firm's perspective, they face fewer financing constraints in transitioning to more expensive yet cleaner environmental projects, which is effectively that firms are included in an index are subsidized by index investors. Alternatively, you could also argue, well, maybe index investors engage with firms on environmental issues, and that's driving the effect. Or it could be that upon index creation, there's just more visibility of a company's environmental performance, which could then also kind of generate the main result. Okay, so first I'm going to show you evidence on this index inclusion subsidy channel. And here our main argument is really that investors are less sensitive to changes in profitability. And the way that we're trying to test this is how share prices basically respond to earnings announcements. And what we compare is like the cumulative abnormal returns around earnings announcement with unexpected earnings, so the unexpected part of the earnings announcement. And this is kind of an illustration of the effect that we have in mind. So, well, if there is an unexpected earnings event, for example, it could be that the earnings fall short of what has been expected. And by the way, expected earnings is something that we measure with analyst forecasts. So we compare the realized earnings with the unexpected part, and if kind of the realized part falls short, we have a negative earnings surprise. So we are here in the left part of the graph, and what we would expect is that there is a negative cumulative abnormal return. Now, if you have a lot of investors who are not sensitive to financial performance, we would expect that this cumulative abnormal return is less negative or more positive, or however we want to say it. Basically, the graph moves a little bit upwards, so from here to here. On the other end of the spectrum, if we have a positive earnings surprise, we would expect positive cumulative abnormal returns. But again, if investors are not as responsive to financial information, we would expect the response to be more muted. Okay, so we also run this as a regression, and what we have here on the left-hand side is our cumulative abnormal returns, -1 day to 2 days around the earnings announcement, and we interact our treatment times post with our unexpected earnings measure. And by the way, we also have all other interactions here in that regression. We just don't plot it for the sake of brevity. And maybe we start in column 3. So here we interact our treatment times post coefficient with an indicator for a negative earnings surprise. So that's the left tail basically of the distribution of the unexpected earnings. And what we find is that for basically that this gap here in the very left tail is roughly 2%. If we look at positive earnings surprise, we find a negative effect, which is exactly what we would expect here. So this has to be below, the treatment has to be below the control group, albeit here it's not statistically significant, but all in all, if we just interact this with a continuous unexpected earning, we find a negative effect, which means it's more muted for treatment companies. Okay, so that's the first piece of evidence that kind of is in support of this channel. The second piece of evidence is that we would expect, if this works through kind of a subsidy channel, that this helps companies who have it more difficult to implement and finance green projects. And we use cross-country heterogeneity to kind of identify companies who have it more difficult to implement green projects. And we use 3 proxies for basically green financing conditions. The first one is the cost of capital for financing green projects. Second one is kind of the amount of fossil fuel subsidies that are paid in this country. And then the last one is kind of the prevalence of renewable energies as a kind of a proxy for how much this market is developed. And then what we do is we split countries into low, medium, and high based on these proxies. And what we find is kind of our effect is primarily coming from countries that have very high cost of capital for low carbon projects, that have very high fossil fuel subsidies, and that have relatively small share of renewables in their energy mix. So kind of this again speaks to that kind of our channel is alleviating some financing restrictions here. But I also promised you to look at alternative channels. So this basically tries to understand, is there an engagement effect? And the problem is, with engagement in an international sample, it's really tough to directly measure because ISS doesn't have good data or any data on international companies. So what we do here is we basically take one step back and classify passive investors into investors who are more likely to vote on climate-related issues, and try to identify whether there's kind of a significant shift following our identification, our event, towards kind of passive investors who are most likely to vote on these issues. So what you see here is basically the passive ownership share that consists of big 3 foreign investors, CDP signatories, which are signatories that have signed the Carbon Disclosure Project, and passive owners that in the US actively vote on environmental issues. And we see that the change in passive ownership in our sample is not coming from any of these type of passive owners, which makes it a bit less likely that there's really like a strong engagement effect happening in our sample. Last thing that I want to show you is the concern or the possibility kind of that index inclusion increases visibility of environmental performance, which then puts pressure on companies to do something about it. And here on the left-hand side, what we measure is environmental incidents per year, which is information that we get from a REPRIS database. And basically what you see in the first column is that's just the extensive margin. So is any incidents covered, yes or no, which is where kind of most of the magic happens in this data set. And we see no statistically significant effect, maybe mildly positive. But the interesting thing is that if there is a mildly positive effect, it's only coming from the ESG indices, which, if you remember, kind of our main result is not what's these are not the indices that are driving our result. And the same kind of argument holds with a number of incidents covered. So here we have a negative effect for, it's like in total, and for the conventional indices, which is what we would expect because we have an increase in environmental performance, right? But we do see a statistically positive effect for ESG indices, which is given kind of the attention that has been put on ESG investing in the last couple of years, maybe not surprising. So all I'm saying is basically there is a visibility effect, but it's probably not driving our effect, because the visibility is mainly on the ESG indices. So here in the last column, we have a cross-sectional correlation analysis where I just kind of compare the change in the number of incidents with a change in environmental scores, and we see no significant relationship between the two. Okay, so 25 minutes is up. Let me kind of conclude. What have we just seen? So firms improve their environmental performance when they are added in an index. It seems that the composition of investors matter for environmental policies, not because investors prefer sustainability, but because their demand is inelastic. And by reducing the sensitivity of stock prices to financial performance, passive investors in some sense subsidize investments in less profitable but cleaner technologies. Okay, thank you for listening.
Thank you, Theresa, for this very clear presentation. So we have a few minutes for questions. So yes, Joel, we cannot hear you.
Thanks. Very interesting paper. Just one question is, what are the characteristics of firms in these non-ESG industries? I mean, it might be interesting to think about what they look like. I mean, you kind of speculated on this, saying that maybe it's easier to increase, ESG performance for a brown company than for a green company. So it'd be interesting to just see, like, what are the stylized facts? Are these more companies which are more brown? And, think about that cost curve maybe.
Yeah, so that's so we haven't looked kind of thoroughly at all the characteristics, but what I can tell you is that in terms of ESG scores, they are like 5 to 7 points below the firms that are included in the ESG index, which is, I guess, I don't know, makes sense because that's what they are selected on in ESG index. But kind of in terms of other company characteristics, probably there's an industry dimension to it, but other than that, I don't remember anything sticking out. Yeah.
Are there more questions? So I have a question. I mean, I have a comment or a question. It's very interesting in the sense that, when we think about ESG investing, we usually think about active investors who are promoting the cause, right? The ESG cause. And here you're taking a different view. You're saying that passive investors could also, be a force for good in some sense because they're less sensitive to profitability. Therefore, they give more leeway to companies. So somehow what this is saying is that within companies, and maybe you can comment on this, there are forces or there are incentives, right, that are encouraging managers to go more green. So yeah, can you comment on this? Because that
yeah,
something else might be at play besides investors is essentially
yeah, so this is a good question. So if there is this subsidy that's coming from passive investors, why do they use it to go green? Why don't they use it for something else? We have a table on this in the paper where we kind of try to understand a little bit what's going on, and kind of our working hypothesis was that, yeah, maybe it's also the prudent thing to do from a manager's perspective. So maybe kind of these companies have a relatively high exposure to climate change related risks. And this is basically also what we find in the data. So we split here kind of companies into, based on the countries where they reside, into kind of those countries that do relatively good or bad, and those countries that have a relatively stringent or not so stringent environmental regulation. And you really see it's from the guys, or from the it's coming from the firms that reside in companies that have a very high exposure to physical exposure to climate change, and who have a very high exposure to also regulatory risk. So kind of that would be our best guess answer to kind of this question. It seems that it is also a prudent thing to do, and now passive investors come in and reduce a little bit kind of the financing constraints,
So
which then managers use. Yeah.
yeah. So does it suggest that active investors have a very short-term view of performance? Because
Yeah.
if they had a
So
long
yeah.
view, if they had a long view, they would internalize what you're describing, right?
Ideally, yes. I guess this kind of that is also what some people have done in the literature, kind of look at holding periods in a sense, right?
Exactly.
And this is also something that's still on our to-do list. We haven't done it, but that is something also that kind of we hear, and kind of many people comment, oh, this seems to be kind of a conflict of short versus long-term orientation. Yeah. It's on the to-do list. I can't show you numbers, but very likely, yeah.
So I mean, if that were the case, you might run other tests, right? You might show that passive investors are not short-termist, right? And so they, you know, I mean, in other words, when passive investors move in, short-termism is getting weaker, right?
Mm-hmm.
And so companies could fund longer-term projects. I mean, that might be an implication of
Yeah.
the mechanism
Yeah.
you've highlighted. Yeah.
Yeah.
Oh, very interesting. Yeah, thank you. Are there more questions? No. Okay. Well, thank you again for
Thank
this
you.
presentation, and I think we're going to move to Joel's presentation.
Okay, let me just share my screen. Find it. Shoot. There it is. Everybody see that? That's okay.
Yeah.
Yes, very good.
Thank you very much. Anyway, thanks very much to Laurent and the organizers for inviting me to present here. It's great to see everybody, even though it's virtually. So this paper is entitled Sustainable Investing in Public Goods Provision. It's joint work with Ilaria Piatti and Xuan Wang. So, this is a theory paper, but, kind of thinking about the public economics literature, it's very standard assumption to think that people care about public goods. And if we, take that one step further, we know that public goods aren't just provided by the government, they're also provided by the private sector. So we could think about firms contributing to the public good. So for example, this we'll use as a running example, they could improve their production processes to mitigate climate change. And so if they do that, it's possible for, investors, we know investors care about risk and return, but they can also care about the public good. So what we're going to do in this paper is to study, investors and firms' choices and an asset pricing model with production and public good provision. And we'll talk about, this is going to allow us to talk about a lot of things, and probably, some things which you'll suggest, which we haven't even thought of. But, we'll kind of start off by thinking about, what are the optimal allocations of wealth and capital? We'll think about the asset pricing implications, and then we'll think about, how does essentially sustainable finance here interact with public provision public goods. So we'll think about government provision, both through taxation and subsidies. So just to give you highlights of the results, and then I'll get into more detail about the model. So first, thinking about allocations of wealth and capital. So we're going to have two types of investors. We'll have environmentally conscious investors and financial investors. Environmentally conscious investors are going to invest more in the financial market. They're going to invest than financial investors. They're going to invest more in clean firms than financial investors. And in fact, they might actually invest more in dirty firms than financial investors. And this would happen in the case where they're investing so much in the environment in the clean firms, and there's a negative correlation, low correlation between the clean firms and dirty firms, that they actually can use investing in the dirty firms to hedge themselves. If we think about asset pricing implications, so we'll show that CAPM alpha can be negative or positive, and it's going to be negative when we compare a stock's relative environmental investment contribution to its systematic risk. And so I'll show you how I measure those things, but systematic risk, we'll use the traditional CAPM beta. But it's possible for a clean firm to have positive alpha, but we show in simulations in most situations the CAPM alpha will be negative, which is consistent with the literature. But it is possible, and we show that it does happen when the clean firms have large systematic risk. Now, when we think about the interaction between public and private provision of public goods, so thinking about improved climate or reducing carbon, we'll show that there is free riding, and this is not that surprising. Free riding leads to the underprovision of the public good, and this is because the investors don't take into account the positive externality that they're exerting on other investors. So there's underprovision. There's crowding out. So if government were to raise taxes and use those what it raises to contribute to the public good, that will crowd out private provision. So investors will invest less in clean firms, for example. And we show that crowding out could be partial, or by which I mean less than 100%, or excessive, by which I mean more than 100%. There's a result, a famous result in the public economics literature, which is that crowd out is 1-for-1, or 100%, which is that when government raises a dollar in taxes to contribute to the public good, that reduces private provision by $1. But we show that it could go either way. In fact, it might reduce it by more than $1. One reason this is interesting, one reason we got involved in this in the first place was, there's this curious stylized fact, which is when Donald Trump was elected in 2016, which seemed to be a surprise election, at least from my point of view, there was a massive surge in sustainable investing. And that seems surprising because it seemed kind of clear that Donald Trump would pull out of Paris, which he did, and reduce subsidies to green firms, which he did, and so that in principle would reduce cash flows to the green sector. But our model offers an alternative explanation for what's going on and for this stylized fact, which is based on this crowd out. Because if the government raises more taxes and funds the public good more, the private sector funds it less. But also the flip side is true, which is that if the government funds the public good less, then the private sector will get more involved and fund it more. So our results say something about that. We also look at comparison between optimal tax and an optimal green subsidy. we show that optimal green subsidies in our simulations perform better than optimal taxes. And we have some extensions, which I may not get to, but if I do, I'll talk about the first one. So we talked about negative externalities. What if the public good is risky? So we don't know actually whether our attempts to improve the public good will do any good or not. And allowing for investors to make donations. So let me take you through the model. So we've got two periods, time 0 and time 1. So at time 0, the investors are going to allocate their wealth to company shares. So this is a primary market for shares. And they'll also allocate to a riskless asset, which is in zero net supply, but endogenous. Firms will allocate capital, with the capital that they receive, to private and public good production. And then, kind of end of the world, production occurs, state of the world realizes, and investors consume. Let me talk about investors first, then I'll talk about firms. So we've got two investors. So we think of these as, large institutions. You can think of pension funds, sovereign wealth funds, maybe activist investors, large hedge funds. So we've got two investors. One I'll call an environmentally conscious investor, and one who is a financial investor. They have the same initial endowment, just by assumption, and they have mean variance preferences over terminal wealth, plus this term which relates to the public good. So here's the mean variance preferences. I think you can probably see my cursor. And here's the part which is where we add in, this is the new part. So this is about the public good. So psi is how much they care about the public good. So the environmentally conscious investor has a psi, which is higher than the financial investor. But we allow the financial investor to care about the public good or not to. Psi F could be 0 if we wanted. And then there's this function which is increasing and concave, which is kind of standard function in the public economics literature, but how much people care about the public good. I should point out that in, just to get closed form results, at some point we might assume that this f function is also linear, and then we extend to look at when it's increasing and concave. So investors are going to be sophisticated here. So they're going to think, when I invest, that's going to affect the provision of the public good. They're going to be able to think forward about how much that affects the provision of the public good. So they're going to internalize this effect. So what they'll be choosing is how to allocate their money among the two firms, which will be clean and dirty. We'll talk about them in a second, and the risk-free asset. Okay, so let's talk about firms. So there's a clean firm and a dirty firm. There's two firms here. And so they're going to receive an amount of capital K, and they're going to choose basically how much they want to allocate between, kind of pure production and public good production. So we assume this Cobb-Douglas structure, where this epsilon tilde n is a productivity shock. Okay, so the firms, each type of firm will have a productivity shock that'll be normally distributed. And there's a correlation between the productivity shocks of the two firms, which I'll call rho. And then, kind of the Cobb-Douglas structure, well, this is how much we kind of think about pure private production, and then how much we contribute to public good provision. So contributing to public good provision could actually increase our output, so it could be a good thing here. Could also be a bad thing depending where we are on the curve. The trade-off between contributing to both is gamma n. So we're going to assume that clean firms have a lower gamma than dirty firms. Okay, so that means that this is they're more productive in producing public good. And just this either means that they find it easier to reduce carbon emissions, so in the case of carbon emissions, or more profitable to do so. So I think it's useful to just kind of anchor our thoughts in what this could possibly mean. And so what does this mean for the firm? Well, this means their investments can increase either productivity or profitability in several ways, that are talked about in sustainable finance. I've already talked about improving the production processes, but it could also mean, happier workers or customers, better relationships with suppliers, and so on and so forth. And kind of, black boxing that a little bit into this production function. And by the way, this is production, but this is also profits in the model. Okay, so what firms are going to choose, they're going to choose how to allocate their money. Their objective function is just to maximize profits, maximize shareholders' value. And so they're not going to directly internalize preferences for the public good. They could get an indirect internalization of this through the discount factor, but they will not will assume that their objective function does not include this. So just to make clear, the total public good provision is G, and that's just the sum of the Z's. Okay, and I'll also define excess financial return of firm and stock. It's just basically how much do they produce over how much capital do they put in, minus 1, and since excess return minus the risk-free rate. So risk-free rate is endogenously determined in equilibrium. Okay, so let's look at the equilibrium allocation. And so this kind of looks like a mess. Let me explain it in pretty plain terminology. So this is how much investors allocate to the clean firm, that's theta IC, and how much they allocate to the dirty firm, theta ID. Okay, and this is a mess, but I'll take you through it in a second. So I think the first thing that should be made clear is, from this we can really see that the environmentally conscious investor invests more in the clean firm than the financial investor. And so this is the investment in the clean firm. I would be, it's for environmental or financial. And basically this is positive because we know that the clean firm, is more effective at producing the public good than the dirty firm, and rho is less than or equal to 1. And so that means that really the only thing that's varying here is this psi. Psi is larger for environmental investors. This whole thing is positive. So that means the environmental investors are going to invest more in the clean firm. So we also show that the environmentally conscious investors borrow from the financial investors at the risk-free rate. So they trade more. So they're investing more of their wealth than they're actually borrowing to invest. And the intuition behind that is, if we think back to their utility function, they've got this extra value coming from the public good, and that's effectively making them less risk averse. And we also show that if the correlation between the two stocks is low enough, so that's this rho, then environmentally conscious investor will invest more in the dirty firm. And as I mentioned in the introduction, is because the dirty firm gives the environmental investors some diversification benefits. So we do some simulations, and just to just point two things out. So here on the left-hand side, I vary the environmentally conscious investors' preference. So it's getting stronger. And we look at the allocations. And I think, the thing that pops out is really that as as the environmentally conscious investor's preference gets stronger for the public good, they invest more in the clean firm, but at the same time, the financial investor invests less in the clean firm. Okay, and this is you starting to see the free riding effect, right? Since the environmental investors, doing the heavy lifting, the financial investor can avoid investing in the clean firm and try to go for higher returns. On the right-hand side, varying correlation. And I think, the thing to notice really is as correlation goes up, the investment for the environmentally conscious investor in the clean firm goes up a lot. And actually, it goes up for the financial investor as well. And this is kind of thinking back to this diversification result. When correlation is high, you don't get much diversification from investing in the dirty firm. So might as well invest in the clean firm. Okay, so let me briefly talk about asset pricing results. And so we show basically that we can think of this kind of like the CAPM, so an extended CAPM, where the expected excess returns can be represented as this new beta, which I call beta G, because it's our model with public goods, times the excess returns in the market. And this beta G, you can see it's not these two things on over here, the covariance and the variance. This is the standard beta, and here's how it's being amended by the public good. Okay, so the one thing we do in the paper is we say, what if we compare this to the standard CAPM, where the CAPM doesn't take into account public good provision. So if we were to write that, so here we write it, here excess returns, standard CAPM beta times excess market returns plus alpha, plus that's everything else which we didn't incorporate. Then we can show that basically there can be a negative alpha or a positive alpha compared to the standard CAPM. And what it depends on is this comparison between the CAPM beta and the relative public good contribution. Okay, if the CAPM beta, which I also, in the paper call systematic risk, is lower than the environmental contribution, relative environmental contribution, then it's very straightforward to show that, well, the public good beta is lower than the systematic beta, therefore this alpha is negative. Okay, so we don't need to be rewarded for this, so that there's negative alpha. On the other hand, if the CAPM beta is very high, then we do need to be rewarded, so there can be a positive alpha. Okay, so then we might think in reality, well, should we see positive alphas or negative alphas? And just here I'm showing you some simulations of our model. So on the left-hand side, we've got psi varying, so psi e, the preference of the environmental investor, and so you can see that the clean firm has negative alpha and the dirty firm has positive alpha. And that's kind of in line with the literature. But we can see on the right-hand side that as a varied correlation, if the correlation is very high, then the alpha for the clean firm can go positive. Okay, and that's just getting back to this intuition, which is correlation is very high, it becomes very systematic, that can outweigh its relative public good contribution, and therefore it can have a positive alpha. Okay, so let me start to think about what is the optimal amount of public good provided, and is the market providing that optimal amount? And so what we do in the paper, I'm just showing it in the simulations, is so we construct a planner who's basically maximizing the utilitarian, so the sum of the investors' payoffs and choosing their allocations. We compare that to the market solution, and what we find is that as the preference for of the environmental investor increases, actually the market solution gets further away from the optimum. And here there's that, this is the free riding intuition, right? So as they contribute in the market solution, as the environmentally conscious investor contributes more, then the financial investor is contributing less, and so that takes us further away from the optimum. We can also see a correlation. So this is kind of a similar story. So we also just to quantify this, we look at what's I can tell you what's the difference between 0.15 and 0.1, but to think about actual percentage and change in the public good, the percentage change between the market and the optimum ranges between 10% and 39% in our simulations. So we also look at taxation and crowding out. So we allow the government to levy taxes, and so they charge a lump sum tax tau from each investor. We're going to allow for some wastage, so that not all of this tax which is raised actually gets into the public good. We can allow that to be zero. We just put it in there. It seems kind of relevant. So the first thing we show, which is probably all I'll show you, is when we have linear public good function, then we can write down the difference in public good under taxation versus the pure market solution, no taxation, in closed form. And what we show is that if this wastage is low, and this preference for the clean firm to produce is also low, to produce public good, then total provision of public good always increases. It's essentially better for the government to do it. That's not necessarily saying that there's not crowd out. There still will be crowd out. There will still be not $1 raised will increase the public good provision by $1. That's not true, but the public good will increase with more taxation. However, in the flip side, if there is more wastage, or the clean firms are actually efficient producers of the public good, then public good provision can actually increase or decrease if investors actually invested a lot in the clean firm. Then the total provision of the public good will decrease. This is the excessive crowd out, over 100% crowd out. So $1 raised by the government to contribute to the public good leads to less public good overall. So we also look at subsidies, and I know I'm kind of running out of time, so I'm going to just go briefly through that. We allow for the waste cost there, and then we compare subsidies to the optimal subsidy to the optimal tax. And so what we can see here is, the red line is base case, no subsidy, no tax. You can see the optimal tax actually only kicks in. So I'm varying this with the preference of the environmentally conscious investor. Optimal tax only kicks in kind of, as this preference is actually very strong. Otherwise, the optimal tax would be zero. The subsidy is always positive optimal subsidy. And it's, if you think about it, the subsidy does two things, like the optimal tax, it takes away from investors. So they both take away from investors, but the subsidy actually provides incentives, so it can have this kickback through the firm's increased production of the public good. So I see I'm out of time, so I'm just going to keep us on time. I'm going to skip negative externalities. In case anybody has a question about this, we do look at the case where we say the dirty firm actually contributes negatively to the public good, and find kind of similar results. A few of the asset pricing results slightly, and I will stop there. Thank you very much.
Okay, thank you, Joel. Are there any questions? Thank you for your very interesting presentation. Are there any questions?
Yes, I think I was not able to raise my hand. I'm not sure
Okay.
if I may.
Engin is next.
Sorry. So a very interesting presentation. Thanks a lot. So I was wondering how the paper relates to the Oemke and Opp paper, who kind of require a mandate for social responsible investing. In your setting here, it seems different, if I got it correctly. Or how would you contrast this?
Okay, so there's a few versions of the Oemke and Opp papers. I'm not sure. I discussed the early versions. I'm not sure I'm super aware of the latest version. The early version, the preferences of investors are quite similar to ours. So I might call them, it's often called consequentialist, which is that the investors care about the public good, and they even care about it if it's not them providing it, if it's someone else providing it. And so we're quite similar to at least the early version of their paper that way. The big difference, as I think is they're talking more about corporate financing, and we're talking more about asset pricing. But yeah, I think our papers are complementary.
And again, we cannot hear you, actually.
We can't.
Can you hear me now?
Yes.
Okay, that's better. Thanks a lot for nice presentation, Joel. It was amazing. So my question is on the more the economic like the footprint of the public good, like because since it's a like the production model, like I feel like these guys who are environmentally conscious investors, do they just check that whether the production of the public good can generate higher footprints, right? Or there is no footprint over here, like the public good just generates something good for the whole public, but not environmentally high footprint.
Okay, I'm not sure 100% understand. So let me try and answer, and then see whether that what I say in response makes sense. So here, they care about, so investors care about the public good. So we could think about that as, kind of reducing carbon to mitigate climate change. So, and that can come through a number of means. It can come either, through government provision, through the firm's provision. We also allow for donations in the model.
Okay.
And is it effective is an important question. And so in the main model, we say we just say it is effective. But we have an extension where we allow for the possibility is not that effective. So we have risk in provision of the public good. And we allow that risk to correlate with firm productivity shocks.
Yes.
And
That's more related. You're right. Okay.
And so that risk, but since it's risk, it could have a positive realization or negative realization, right? So it could mean it doesn't end up in producing the public good, or it produces more of the public good than we expected. But we show, because of this risk, that environmentally conscious investors don't invest as much, because they're kind of putting all their eggs in one basket if there's this correlation.
Okay, cool. Thanks. Thanks, Joel.
Are there more questions? So actually, I have a question. In some sense, what's very interesting is the comparison between the two papers, right? Because Joel, and I mean, your presentation was remarkably clear. So we understand that so say there is an investor who has low sensitivity to ESG concerns. We could even set a new model that psi coefficient equal to 0, right? So that
Yep.
somebody was just a pure, I guess, mean variance investor in that case. Okay.
Mhm.
So in the tangency portfolio, there would be less of the the green farm and more of the other farm, right? Compared to the other, compared to what the green investor is buying, right?
Mhm.
But so in that sense, I mean the mean variance investor, I don't know if we can view him or her as a passive investor. I mean, it's
Mm.
somebody who's holding the tangency portfolio, not the market. Okay, so there's a wedge there. Does that mean that Theresa's results would hold in your environment?
Huh. Wow, you're really pushing this to a very intriguing thing, which I hadn't thought about because I've just seen Theresa's paper for the first time.
No, of course, it's a challenging question, but that's actually, I think, it gets the
Yeah,
benefit of
yeah.
the
So,
format. Yeah.
so if I put Theresa's result in a nutshell, it's we basically we have more indices for passive investors, and that creates more green. Um, through, and she showed kind of a variety of mechanisms. So I think the mechanism Theresa, you can correct me. The mechanism you prefer is the one in which it offers this kind of I guess subsidy to firms. Um, I I I don't see that mechanism operating in our model. Um, so if we were, so what you could say maybe, Laurent, is either, if we wanted to do a comparative static in our model, we could either alter the number of financial investors, so the proportion of them,
Yeah.
or increase their wealth, and see what happens. I don't think that's going to do good things for the public good in our model. So maybe I think that points out that our model is pointing to a governance channel, which we don't have embedded into it.
Okay. Okay. I mean, there could be a different channel going on. As I was listening to you, I was thinking of the following, and I could be wrong, obviously.
Yeah.
So in some sense, if you have three types of investors, you have the mean variance person, right?
Mhm.
Holding the tangency portfolio. There is the green investor, right? And then there's the market, and the market is going to be the combination of the two. So somehow the market is maybe a little bit driven towards ESG investing, right? Because some of investors have an ESG tilt. Then you bring in the passive investors, and I think the passive investors would amplify what the ESG investor has been doing, because the passive investor would buy the market, right? And the market is driven in part by the taste of the ESG investor. So maybe in that case,
Yeah.
if you had this third category,
Yeah.
Theresa's effect would actually
Yeah. I mean,
but basically the passive guys would amplify the ESG taste of
I think
the
that
tilt of ESG investors. Yeah.
the trick would be the mechanical effect versus the real effect, because if I just throw money on both firms, there's going to be more public good, which I feel like is a bit mechanical. So if I were to add those passive investors like you're suggesting, but in what proportion would I take away the ESG investors and finance? That I think that would be a less obvious
Okay.
effect. But I think that's interesting to look into.
Yeah, for sure. Yeah. Are there other questions or more questions? No? Okay, well, thank you so much to both of you for giving very provoking and very clear presentations. It's very nice to be able to get to have the feeling you really get to the bottom of the paper. So thank you again for this. Next month we'll meet. We'll have a session on expectation formation. So Catherine Schlafman from Copenhagen Business School. We present a paper on expectations and wealth heterogeneity in the macroeconomy, and it will be followed by a presentation by Peter Andre from Goethe University Frankfurt. We'll talk about mental models of the stock market. So I hope that many of you will be able to join us again next month. So thank you again to our speakers, and see you soon.